Should I use the RRSP? Should I not use the RRSP? Is it a great account? Is it a bad account? How do I use it? If you're super confused about this account, perfect. You're in the right place, and I'm going to explain everything you need to know about how this account works. And even if you know a little bit, stay till the very end because I'm going to go over a bonus tip that's going to blow your mind. So without further ado, let's jump into the video. Now, if you haven't watched my TFSA video, have a watch. That one's going to give you some basic knowledge about that account so you can actually compare it very easily with the RRSP and kind of see how they're similar in some ways, but very opposite and different in other ways. Now, of course, let's start with a little history. The RRSP account has been around for a long time. In fact, it started in 1957 as a retirement savings plan that the government created to be able to help Canadians save money for their retirement and then pay less tax on that money later. So essentially, the RRSP is what we call a tax later tool. Now, compared to the TFSA, which is a tax now, tax-free tool, it's a tax later, tax deferred account. So the difference with the TFSA is that, of course, you pay income tax on your money that you earn, and then you invest that into the TFSA, and then you do not pay tax on the money later. Whereas the RRSP is actually the opposite. So you're going to actually get a tax deduction on any contributions that you make, which means that you essentially will not pay income taxes on the money you put in now. But at the time that you take it out, whether it's in a year from now or 10 years from now or in retirement, which is the most common time to take money out, you will pay tax on your income taking money out of the RRSP then. So essentially you will pay tax later on your RRSP, but it's not exactly that simple. So let's break down how that mechanism actually works. Before we talk about when you pay tax on your RRSP and how you pay tax on your RRSP, we have to talk about a concept called tax sheltered growth. Similar to the TFSA, the RRSP is also what we call a tax sheltered account, which means that the basket that we're putting money into, or the bucket we can call it, is actually protecting your investments from paying tax on the gains year by year. So you do pay tax later when you take money out, but while your money is within the account, as long as you don't touch it, as long as you don't pay any money to yourself, it does grow tax-free. So the TFSA and the RRSP are similar in the sense that they're both tax sheltered accounts. Now, if you've watched my video on the TFSA, you'll understand that this account is not really meant as a savings account. In fact, it's better suited as an investment account. So we can invest in stocks, bonds, ETFs, mutual funds, or other qualified investments, just like with other accounts like the TFSA. But the reality is, if you put $100,000 over 30 years into your RRSP and you only end up with $100,000 30 years later, you did not use the RRSP for its intended purpose, and you did not nearly take advantage of the benefits that it actually has to offer. Now, you might be wondering, how do I buy an RRSP? Well, you don't actually buy this account. You buy units of stocks, bonds, index funds, mutual funds, and other investment products, and those are going to be held within an RRSP. So the RRSP is a registered account, which means it's linked to your social insurance number. The government essentially tracks how much you're putting in, and it gives you a certain amount of room that you can add money into, and then that money can be used then to purchase investments within the account. So the account is just simply a government account. It's just the bucket. But what's inside of the bucket is what really matters in terms of growing your money. So today what we're going to talk about is the actual account itself, just that bucket, and what benefits it actually offers for you. Now, we've already talked about the tax sheltered aspect, how you put money in, it grows tax-free, but what happens later on, and how do you get the tax deduction initially? So how it works when it comes to tax deductions is we have to understand the tax system in Canada, and it's very complicated if you don't understand it. I'm going to break it down very simple. So how it works is we have what's called a progressive tax system. And in a progressive tax system, we have both a federal and a provincial income tax rate, and they go by different brackets. So this chart is actually showing the approximate combined federal and provincial tax rates in British Columbia. So of course, every province is going to have their own separate rates. So if you look at the very bottom, you'll see in the chart that the first bracket is $15,700. What this means is that on the right side, we have our 0%, meaning the first $15,700 that you earn in BC is actually taxed at 0%. So you don't pay any tax on the first $15,700. So that means if that's all the money that you made the whole entire year, that's exactly how much tax you would pay. But the moment you make $1 above that $15,700, you will get taxed on that $1 at the first tax bracket, which is going to be 15%. So basically, the first $15,700 was still tax-free, but the $1 that you earned above was taxed at 15%, or 15 cents to be exact. But that's a crazy example. Let's look at a more realistic one. Let's say that I earned $100,000 of income in a single year. Well, $100,000 falls between these two brackets of 95 and 110,000. Therefore, I'm somewhere in between the 28 and the 31% tax rates. So how it would actually break down is the first $15,000, I would actually not pay any tax on that. But from $15,700 to $23,000, that difference is $7,300. This chunk right here, and only that chunk, that's what gets taxed at 15%. Going up from there, from $23,000 to $47,900, that chunk of $24,900 is getting taxed at 20%. Okay, following along so far? Perfect. Now, if we go from $47,900 to $55,800, this chunk right here of $7,900, that's getting taxed at 22.7%, and so on and so forth. Finally, we have the next bracket from $55,800 to $95,800, which is a $40,000 chunk. That chunk is getting taxed at 28.2%. Okay, and then of course we have the remaining $4,200 from $95,800 to $100,000. That is going to fall within this bracket. It's not going to exceed it, but it will be within that bracket. And just that little chunk gets taxed at 31%. Perfect. So now we have an understanding of how we're actually getting taxed. And the reason that this is a fair system is because if they didn't have this and you made $1 above that threshold of $95,800, you would actually end up getting taxed an extra nearly 3% just for actually earning $1 more. So they do it progressively so that it's fair and you're taxed level by level. Now, how it works for the RRSP, which is what we're talking about today, is actually the same thing, but in reverse. So let's say if we go back to our example, I earn $100,000 and we know I'm getting taxed bracket by bracket all the way up to that 31% amount. Well, if I go ahead and I put $4,200 in my RRSP, that's going to bring my income down because it's a tax deduction. So the money that I put in, that $4,200, that brings my income from $100 down to $95,800. And because I paid 31% on that last chunk of $4,200, I will receive a refund back on that $4,200 of 31%, because that's the amount of tax that I paid on that $4,200. So we would go $4,200 times 31%, and that gives me exactly $1,302. So essentially, in theory, I would get a tax refund on my RSP at the end of the year when I file my taxes of $1,300 if I made $100,000 and I put $4,200 in my RSP. Now, the question is, what if I put more than $4,200 in? Well, of course, it's going to bring me into the next lower tax bracket. So that will actually give me more of a refund, but the rest of it is going to get refunded at a slightly lower rate. So for example, let's say I have an income of $100,000. I decide to put $20,000 into my RSP. Well, as we know, the first $4,200, that amount is going to be refunded at a rate of 31% because I'm in that highest tax bracket of 31. But the remaining amount of that $20,000 that I put in, which is $15,800, that is actually going to get refunded at 28.2% because that remaining $15,000 was taxed at 28.2%. So there's no tricks here. It's really straightforward when you understand the basics, but this is how you can use an RSP to your advantage. But by getting that refund now, you can take that extra money at tax time and hopefully be smart with it and invest it. And if that's what you're doing, you can put that in your TFSA, you can invest it into another account and grow that for your retirement as well. So now you might be thinking, well, this sounds pretty cool. I'm getting all this income tax back. I'm getting all these deductions. What's the catch? So the catch is that when I take money out of this account later, I'm gonna pay taxes on it. So what is the best time to take money out of my RRSP, and should I even be using this account? Great question, because depending on your scenario, you may or may not want to use this account right now, and you may want to decide when you're actually going to take it out, because proper financial planning will save you tons and tons of money versus not planning appropriately, especially when it comes to using the RRSP. You see, the RRSP can be an extremely powerful tool when used correctly. And the bonus tip that I wanted to give you, I'm going to talk about at the end of this video, so stay tuned, but it's really, really exciting if you know how to use this account properly. Now, to keep it simple, for most people, if you're not earning above $60,000 in a year and you live in BC, it might not make sense to use the RRSP because you have to pay tax on the money that's in there later on. So if you're in a low tax bracket like 20% and you put a bunch of money in this account, then let's say later in retirement you have $2 million in your RRSP, you'll be actually forced to withdraw a minimum amount at a certain point in time where you will actually end up potentially paying more tax on it down the road. So you definitely want to avoid that, because we have to use this when your income is high and take money out of this when your income is low. That's the whole purpose of the RRSP and how it was designed. So let's just say, as an example, if I make $175,000 in a year, I'm around a 40% tax bracket. It probably makes sense for someone like me to put money in my RRSP, because that's going to give me a large refund now. And in retirement, let's say I'm taking money out of that account, it's going to be taxed, but it's going to be taxed at the rate that I'm at. So if I'm no longer working, I have no other source of income coming in, I might be in a very much lower tax bracket, even 20% or 15% or even lower. So it makes a lot of sense if I'm a high income earner now, so that I can take money out later at a lower rate. And that's going to be overall very beneficial for saving a lot of money on taxes. Now, some of the rules around RRSPs include the limit. So the limit on how much can be put in, it works very similarly to the TFSA. So also with the TFSA, any unused room from previous years does carry forward, and it's the same exact thing with the RRSP. So for example, if you're 18 years old in Canada, you are eligible for contribution room in your TFSA as long as you have a valid SIN number. So let's say you're 20 years old and you have 2 previous years of RRSP contribution room. Those 2 previous years is going to be calculated at 18% of your income, up to a maximum of about $32,000 per year, and that actually increases over time. So just as an example, let's say when you were 18 years old, you went out and you worked and you were crushing it and you made $1 million that year, which is very unlikely, but let's just say you did. Only $32,000 is the maximum that you'd be given as a contribution limit for that year that you were 18. But if you didn't make a tremendous amount, then you're getting 18%. So it's 18% or 32,000. But let's say you only made 50,000. Well, then 18% of that is $9,000, and that would be your contribution limit for that year. Let's say at age 19, you didn't use your RRSP the previous year, but you got that $9,000 of room that carries forward to the year you're 19. Now, let's say at 19, you also made another $50,000. You get another $9,000 of contribution room. And if you don't use it that year, it carries forward and so on. And in terms of age limits, I already mentioned that you have to be 18 years old to actually open this account, depending on the province, but you are eligible for contribution room since the age of 18, no matter what province you're in. But in BC, where I live, the age of majority is 19. So you can't actually open the account till you're 19, which I think is ridiculous, but that's the law. However, the age limit on the back end is actually 71. So you must stop contributing the year you turn 71 to the RRSP. That's the maximum. In fact, you're actually forced to convert an RRSP to another account called a RIF. And a RIF, or RRIF for short, is actually meant to be an income paying account. So that account is automatically going to be paying you income every year at a mandatory minimum amount, which increases over time. So you eventually will be forced to take all of the money out, or most of it, out of your TFSA. And not to mention, when you do pass away, it does get taxed to your estate all at once, which is another topic that we should discuss at some point. But for the sake of today's video, we're going to focus on just the RRSP. One of the really key benefits of the RRSP is actually the homebuyer's plan. So if you're considered a first-time homebuyer, you can take out up to $60,000 from your RRSP tax-free to use to buy your first home if you are qualified as a first-time homebuyer. And the criteria on that is going to be in my FHSA video that I'll be doing soon. Please make sure you watch that, especially if you're a first-time homebuyer in Canada, because that account is in some ways even superior to the RRSP, and you can actually use both the RRSP and the FHSA at the same time to take money out of the accounts for a down payment. But for the RRSP, the benefit is if, let's say, over the course of 5 years, you were saving money in your RRSP and you managed to save $60,000. Well, if you got a 25% tax refund on that $60,000, that is $15,000 additional dollars of tax money that you received back in tax refunds. So not only do you have $60,000, but you also would have received $15,000 in money that you can now use for your down payment also. So that's an amazing way to get some extra money in the form of taxes to buy your first home. But the only problem with the homebuyer's plan is that you have to recontribute the money that you take out to your RRSP back within 15 years. So if you took out, say, $60,000, which is the limit, and you can take out any amount, but let's say you took out $60,000, you'd have to put back $4,000 a year for 15 years in order to satisfy the recontribution rule. And if you don't, whatever's money's left over after that 15 years is up, you're going to have to pay back the taxes that you were given as a refund initially. And it's only fair because, of course, you were going to pay that tax anyways, but make sure that you recontribute that back into your RRSP incrementally year by year. So you can't just skip a year because you will get penalized. You want to make sure you're doing it incrementally, or you can also pay it back early or over contribute in order to do that. And you're not going to get a separate tax deduction on that recontribution. You actually have to designate that as a recontribution separately when you file your taxes so that the CRA knows that you're repaying that. So make sure you don't forget to do that, or you could also get penalized. But all in all, it's a really great benefit. And at the end of the day, it's definitely worth it because you're just putting money back in your own retirement account in your own pocket for later. There's another benefit called the lifelong learning plan. Now, I personally haven't seen this being used too many times, but it is for generally mature students or Canadians that have a lot of money in their RRSPs or even a decent amount, but they want to go back to school or back to post-secondary. So for those that go to post-secondary, the government will allow you to take out up to a maximum of $20,000 from an RRSP for the use of tuition costs, but the same rule applies. It does have to be repaid within a 10-year period rather than a 15-year period with the homebuyer's plan. Another small benefit that's worth noting is the RRSP has a US dividend advantage over the TFSA. Now, although the TFSA is tax-free on growth, the US companies that we buy as stocks, if they pay dividends, because there's not a tax treaty when it comes to TFSAs, there is one with RRSPs. So that means if US stocks are paying dividends, the US will actually withhold 15% as a withholding tax on those dividends. Then they will pay you the remaining 85%. With the TFSA, that is definitely a problem. But with the RRSP, it's actually not, because it's exempt from that withholding tax rule simply because the US government recognizes the RRSP as a retirement account. So although the TFSA does provide tax-free growth, you will actually receive less on dividends overall versus if you have dividend paying stocks in your RRSP. So sometimes the RRSP could be a better option if you do like to hold some dividend stocks, ETFs, or other funds that pay dividends frequently. Now, one other thing to watch out for is the overcontribution rule. So for RRSPs, it's definitely recommended to be careful and check your limit before you're actually contributing each and every year. Because if you do overcontribute, you will be penalized at 1% per month, similar to the TFSA. However, there is a grace amount in the RRSP of $2,000, which is a lifetime grace amount. So that means if you do overcontribute, that's okay. You still have a $2,000 overcontribution buffer, but make sure you don't overcontribute, guys. It's really there for just emergencies. Now, as I promised, the bonus tip that I wanted to share on RRSPs is using it to achieve early retirement. Without going into too much detail, I'm going to make a separate video on strategies using an RRSP, but I want to give a very quick tip on how you can use this this very, very effectively. So RRSPs, like I mentioned, are going to give you tax deductions in the beginning. Let's say you're getting all your tax deductions on your contributions now, and then you want to achieve and plan for an early retirement, meaning you're retiring before the average age of 65 and instead retiring around 55, 50, 60 even, or any time before 65. What you can do is what we call an RRSP meltdown strategy. And what that entails is you take all the money in your RRSP and you start to melt it down before you reach the age of 70. Now, why 70? Because at 70, it's the latest that you'd ever want to start taking your Canada pension plan and even your old age security, which are government benefits, which we'll talk about in a different video. But by doing that, by deferring those government benefits, you're actually getting roughly 40% more. And by taking money out of your RRSP before you reach 70, you're essentially taking it out at a time when you have zero or very, very little tax or income that's being earned because you're no longer working, you're not receiving taxable benefits like C.P.P, you're not maybe receiving pensions from other taxable sources, and you're not receiving old age security either. So therefore, not only do you take RRSPs out completely by the time you reach 70 and pay very, very little tax on that, but you also get more government benefits later, which is an absolutely outstanding way to use the RRSP. So watch my video on C.P.P, and that's going to explain a little bit more about this. But if you want to know more about the meltdown strategy, please comment below and I'll definitely go over it in a different video in a lot more detail. I hope you guys enjoyed the content and got lots of value. If you did, please leave a thumbs up and subscribe, and we'll see you in the next one.